So this here is the Pro Trader swing trading checklist. It's a simplified version here. It's got a lot more information on here usually, but that's locked. And if you decide that you want to continue with your career, as I said, you can jump into protraderx.com and enroll there, and it'll unlock the rest or the second swing trading strategy. We do have day trading strategies available as well, but for beginner traders, I believe everybody should start with swing trading just because it is the most simple to understand and comprehend before advancing into the day trading strategies. So this here is, and this is specific to currencies. Now, there are 4 critical criteria required, right? Regardless of if you're taking the reversals or power trends or whatever strategy you're taking, there are 4 critical criteria. These are a must for every strategy that you take. And then there are 2 strategy-based criteria, right? Likewise for the pip snatcher, hyper trade, reversals, these different trades, they also require, they've got strategy specific criteria. Right, so 4 critical and 2 strategy specific. First things first is condition. We've already covered this one. So trending and ranging markets are oscillating and can be traded. Choppy markets are deemed indecisive and cannot be traded. So I've got these little tool tips here as reminders, right? I'm going to share this with you so you can download it and go through it and take some trades for yourself. So oscillating or indecisive. I've got some little hotkeys here, X and Z. So let's just go back to our first condition here. Is the market oscillating? Yes. Which currency pair are we trading? Pound Aussie. So we go down, we find Pound Aussie over here, and we would put that as a Z. It's oscillating, and that'll go green. Now, at the time of doing this, you'll have your bar. You can delete the data to the right using bar replay. We won't do that today, just because we'll work our way through the entire data. So it also depends when you're looking at it. Like if this was the, let's just say you're looking at taking an entry around here, you might think, yes, it is oscillating. You're looking at historical data. You're always looking to the left. Has this been an oscillating market up until this point or today? And it will all just be black to the right, right? Makes sense. So if you can determine that historically it is oscillating, cool. You'd mark that as green. Now the next is phase. Are we currently in the run or the pullback? So sell on the runs, buy on the pullbacks. Inverted in a downtrend, of course. Has price sufficiently pulled back, or is it mid-run? So here, for example, has this sufficiently pulled back? This one was a little bit challenging to tell because it didn't pull too far back. Now there are other indicators that you can use which will help, like Fibonacci retracement, where you can go, and if it's pulled back to 382 or 0.5, which is like the red line, the purple line, that can indicate that the pullback is sufficient. Something like up here, when this ran up and this little pullback happened here, has this sufficiently pulled back? Well, not really. It's only 2 candles and it hasn't formed any deceleration. Like we wouldn't be taking that as a trade long. Makes sense, right? Sufficiently pulled back is, has it pulled back about 1/3 of the way or more or thereabouts about when it runs? Is it about 1/3 of the way or has it just gone sideways? So that's probably a good rule of thirds. So yes, it has. Well, you go ahead and mark that there. Let's actually go. Let's work with. Let's do the bar replay. Let's go. So here. So high, low, high, low. Again, I'd be ignoring this little lower high here because 1 or 2 candle can't comprise a new high. This is actually what I'd call a complex pullback, right? But more on that later. So this is a pullback, happy with that. It's sufficiently pulled back. It's about a good 1/3 or more of the way back from this previous run, starting here, that low and that high. It's about half the way or 1/3 of the way back. Happy with that. So market phase, has it pulled back? Yes. Support resistance, has it got 3 touches from a support resistance level? Let's go ahead and draw a level in here. So this is often what I do with the support resistance. I'm looking at my entry first, and then in the order, I then go and draw a line of where a support or resistance level needs to be. So this is support. It's just a horizontal line. And then I go back and check if it is a valid level or not. If I can't see if it's a valid level or not, then I ignore it and say, okay, this might still be pulling back more. But if we see we had a rejection here, with this little break and retest here, but bounce, these are very good bounces. When we see big movement down and then big explosive movements away from a level, it's very, very good level. Rejection here, but that's more than enough. We need 3 or more rejections. Do we have that? Yes, we do, 3 or more touches. So has price bounced off a quality SR line within the previous 2 candles? Yes, it has. Deceleration, right? Have the last 3 completed candles formed progressively smaller? This confirms deceleration is present. So have they gotten smaller, or have we even had, this is also a sign of deceleration, this little doji candle, as we just spoke about with the high tide, low tide example. So price is pulled back here. We even had a bullish candle here. It's a reasonably large bearish candle, but then I had this doji candle, and I really, really like the support level. So I'm going to say sufficiently yes, that has formed deceleration, that has pulled back. So happy with that one. Now this is where we get into the power trends, the actual 2 strategy-based criteria. So this strategy is based purely off raw price action, and now we go ahead and turn our EMAs back on, the red line and the blue line. So the first criteria is in a long trade, so long trade being up, the 50 EMA must be below price, right? We're going long on this. We're all going to just be taking up trades here mostly. So the 50 EMA needs to be below price. So we're not trading towards the 50 EMA, which is the red one. We're always trading away from it, right? Now, this is good. Prices, again, is the body of the candle. We're not considering the wick here. That price is actually, this is very nice because it's actually rejecting that daily 50 as well. So again, it's like dynamic support and resistance, which we're talking about. Dynamic support, and this also this support level here. So we've got 2 levels of support. Again, we're just stacking together confluence. And there's that 50 EMA. Is it below price? Yes, it is. So we can go ahead and we can mark that one as well. Now, 20-50 EMA zone. So if you were to take the 20 and the 50 EMA and you were to color this in with a pencil, let's go ahead and remove that. You know that support level's there. So if you were to like color in the distance between these 2, it doesn't matter which direction, if it's red above blue or blue above red, it doesn't matter. Just you color in the distance. That's the zone there. So this is price must have traded somewhere within the zone between the 20 and 50 EMAs within the previous 2 days candle formation. So it has to have reached this level. Like here it reached it. We wouldn't be taking a long position here because we're not in that zone, right? So why we do that is this is also another indication that price is sufficiently pulled back. Because those EMAs trail behind price, they're slower than the price action, the pullback occurs. That would have been a great trade there, actually, a great short position, right? It's pulled back, deceleration, it's got the small candle, it's got the high test candle here, and then price broke to the downside in this downtrend. Great trade, I noticed that one. And then you're within that 20-50 EMA zone. So 20-50 EMA zone, yes it is. So what do? Go ahead and mark that as green. Now, if any of these are red, doesn't matter how many green there are, if there's one red, we do not take the trade. So we need to have all 6 of these criteria, they all need to be green, right? When they're all green, like such, that is when you execute on the trade. Makes sense, right? So it's very mechanical. We're going through, we have a process that we're going through and checking each of the boxes. It's like your pre-flight checklist. If all of them are checked, we go ahead and place the order on the trade. I'm going to show you how to do that. We're going to go into more detail on that in the next video, but I'm just going to show you how it plays out. So over here, how we'd be placing our order is we would go ahead and put our entry. So this is an entry order. We don't take live entries. So as a swing trader, you're looking at the charts before the daily candle forms. So we're always basing our data on the previous day's candle close, right? So we've cut the data off here, but what would be happening is because these are live markets, you'd see a new little candle forming while you're on the charts. There's always a new candle forming. Now, 5 p.m. Eastern time, US, New York time, that is when the new candle forms. So we want to be looking at the charts sometime between 3 to 6 hours, or between 1 to 6 hours after that candle has formed, and basing it just on that previous candle close. If we were to look at the charts at, say, 7 p.m. Eastern time, what we'd find is that there's a new little candle forming of only 2 hours worth of data, right? Which is not, we're not going to be looking, we're not going to be considering that. It'll only be a very small candle, and it can be misinterpreted as, say, a doji candle, but that doesn't make sense because it's not what we're, it's an incomplete candle. It's only 2 hours of a 24-hour candle. Now this is specific for swing trading. That's why we are looking at the daily candle. Swing traders trade the daily time frame, whereas day traders trade the intraday time frames, your 1 hour, your 4 hour time frames. But for swing trading, we're looking at the charts once every 24 hours for 30 minutes to an hour, and then you're deciding if there's any trades or not. Once you've identified that there is a trade, you set what we call an entry order. So you set the entry order. You don't need to be sitting in front of the charts all day, as a common misconception. Once you set that entry order, you go to work. You go to the beach. You go do what you need to do. And you've got those three things. You've got your entry price, you've got a stop loss, and you have a profit target. So you go ahead and you put your entry price, and again, we're going to cover this tomorrow in more detail. Entry price is above the wick or above the nose of the candle here. So it's above the wick, and the stop loss is below the wick. So we're kind of straddling the position there, straddling, right? Now, the profit target is up to recent highs. It can be recent high, or you can be trailing your stop even further, right? So there's two options. You can have a profit target, or you can have no profit target. So this position, when you size it up, you'll always have to put something in there or look in there, but we'll use position management. So it depends what your skill level is. If you want to be actively managing that position, by actively managing, it's checking in once per day for about 10 minutes or less, probably 2 minutes really, and then trailing your stop loss up behind the previous day's candle, which we're going to cover now. So that's how it would look. So what this means is, for this to trigger you in, the price of the new candle will need to break the high of the previous day's candle. So price will need to run up and break that high. And as we can see, when price is pulling back, the high of this candle here was up here. The next high was here. The next high was a little bit lower. It was very similar, but slightly lower, and then got lower and then got lower. So this helps us not get in too early, right? When the high of the previous candle is broken, that generally indicates price is about to move up, right? So if we were wanting to go short here, wanting to go down, we can see prices, the highs here are just going higher and higher and higher, right? These are the wicks of these candles. So it can help you not get triggered into a position that the pullback isn't going to occur on. So if this price kept going down and it didn't break that high, you wouldn't get triggered into the trade at all. And then you'd remove your position, and then the next day you would reevaluate and see if the setup is still there. Makes sense, right? So let's see what happened. Okay, so it triggered the position in. So it broke up here, triggered us in, and carried on up. What did it do? Kept going up. Now at this point, big aggressive move up here. What we'd be doing is, because it's run in more than 1% running profit, we can tell by just moving where price is now. So we're up already 2% running profit. The trade management methodology that we use is, if you are running in more than 1% profit, you remove risk. So you actually move your stop loss to break even. So now if price pulls back, you don't lose anything, right? That's if you're in more than 1% profit. Now, in addition to that, we want to be securing profits by trailing our stop up behind the low of the previous candle. Because again, once the low is broken, we can see these are the lows, low, low. If we were trailing our stop up, it would, behind this run here, it would begin here, and go to this candle, then go to this candle the next day, then this candle, then this candle, and then that candle, and then it would have pulled back and taken us out for profit here. So we'd be moving this up not only to break even, because we're beyond 1%, but then we'd also move it up behind the wick of that candle. Now, next one carries on up. Great, so we now secure some profit put it behind the wick of that candle. We don't want to put it right on the wick, but just like a bit behind. Now, often I get asked, like, how much, how many pips? Eyeball it. You just eyeball about that much, right? And it's all in proportion to the size of the trade, of the candlesticks, things like that. Now, if we zoomed in on the micro time frames on a 5-minute chart, that distance is going to look like a lot. But we're not trading the micro time frames; it's the daily time frame. So, I can't really give a fixed amount, but it's 1% of the overall trade if you wanted to, or a tenth of the size of the candle, something like that. So moving on. So it carried on. It exploded to the upside again, right? So we'd been going ahead, trailing our stop up like this. This is one that we just didn't put a profit target on, right? Okay, so then we trail our stop up again, up behind this one. And this is each day. So we've been in the trade 1, 2, 3, 4 days now. And each day it's only 5-minute trade management. All we need to do is take this line, we draw the line there, and then we copy this coordinate over into our trading software. Cool, and then that's where it took us out. So it ran up and then it pulled back and it took us out for how much profit? There was a 2.91% profit, which we just made off that one trade over the course of 5 days. 5 days, 1 week, 2.9%. It's not too bad for one trade, right? And that's, considering the banks are giving you a measly 0.5 or 1% return. Term deposits, maybe you're getting 2.5% return on. You did that in 5 days, right? They give you that per year. So anyway, moving on. That's how that looks. Let's go, because I know this is becoming quite a chunky video. Let's go ahead and go through some positions. We go ahead and delete. We'll bring all of our data back because I did this just not too long ago. I went through and I positioned up. This is just a randomly selected currency pair, by the way. Just at a recent data, I just scrolled back to find a range. Because again, if it's not ranging anything, like any of this kind of ugly price action, I just ignore it and move on to the next currency pair. So I just went to the first one that I saw and then scrolled back until we found a range that was tradable. And then I went and I put in the different positions. So that was the one that we just took there. 2.89 is how I had positioned it up originally, where we got 2.91, however. Next position would have happened here. So again, what do we see? It had, if this runs and pulls back here, let's consider condition, right? Market condition. We're still in this higher highs, higher lows forming. Next one here, phase. Was it in a pullback? Had a pullback? Yes, it pulled back here. Right, support resistance. Had it support resistance? Yes, it did. If we go back, had a rejection here. Go ahead and draw in that line there. It did have that, and then deceleration. It had deceleration. So price was just getting ever smaller. You could see by the time it reached here, price was very, very, very weak. Now, it didn't really have any acceleration or top speed. It didn't really have a mid-range. The whole way down, it was just deceleration, right? Now, you certainly could have, let's actually get a little bit closer into this. So this here would have been a valid entry if you took it on that candle there, right? What would have happened? Would you have triggered it in? No, it wouldn't have, because the high here was lower, as lower high, right? So then the next day, you could have taken the entry and you could have straddled this little candle here. Would you have triggered in? No, you wouldn't have, right? Because again, the high, the wick of the candle is lower. So then the next day, you could have taken it on this candle, right? Did it trigger you in? No, still didn't. So sometimes you can be setting multiple orders, and the entry criteria were satisfied at this stage. We had this low test, we had these dojis, we were within the 2050 EMA zone. Back here we weren't, so we weren't going to be taking any trades, but from the time it reached that 20 EMA or the 2050 EMA zone, and price is below, the 50 EMA is below price, that's when we can start taking entries. And then we take the entry on this candle, and that was where price popped to the upside. That was finally when that broke, and we ended up taking profit on that one. So that's what that's why we do that entry order above price rather than doing a live market execution, because we don't know. Price might continue down, and that's kind of a little extra safety mechanism built into the strategy, right? So let's zoom out again. Cool. So these are the core principles still. Now moving on, next position. Okay, next position occurred over here, as we can see, and all of these were managed behind those recent lows as well. I know I've been fondling with this position, and something like that. So if you go through, you'll see trailed the stop. We started trailing the stop after we reached 1% profit. So the stop started trailing. We didn't begin trailing here. I was after this candle formed that we then went to this low, then this low, then this low, then all the way up to the low behind that doji, which then turned around, broke down, and stopped us out for 2.3% profit. And I'm looking for all trades at this stage. We're not just picking out the winners. We're looking for any setup, and if there's another setup that presents, we could take that one as well. Oh, I actually missed this one. That was a solid setup right there. Oh no, we did have it. I just didn't get it in the right order. Now this one here, even though it exploded to the upside, like look at that. That could have been an absolute monster, 4.42% if you'd managed to get out at the high. But because we're trading a strategy here, regardless of what happens, and this is where the emotions of trading can come in, you might be upset at the strategy and you might change the strategy because you saw, wow, I got it all the way into 4% running profit and I only exited for 0.93% because I've trailed this stupid stop loss, right, the way that I did. And again, we ran into 1% profit, more than one, so that means that we put our stop behind the previous day's candle, and so on. So that is that. I actually had to go back and find a losing trade. I didn't think that. I thought there was going to be some loser in here somewhere, and I had to go back further to find this one, which was a valid trade, but still a loser, right? Where price ran, pulled back here, so we're kind of seeing this oscillation. So similar highs, similar lows. So not the cleanest of ranges, or this is probably more of a range. This is what we're talking about, those highs and lows. But anyway, it looked pretty good. We got the deceleration, entered, ran down, pulled back, stopped us out here. So that would have been a full 1% loss. But I actually had to go back and find that one. So the strike rate of this strategy is as you can see, it's incredibly high, and the profitability is also very, very good. So this one over here, 2.32, and that was the 5 trades that I identified over the course of October through till May. That's the data that we've got. Now you can go through. This is what we're doing here is called backtesting. You're going to learn how to do backtesting in the next video, but from what we've done here, you could probably piece it together. But of course, you're going to have to set up your trading view first, which we'll do together on the next video. So what have we got? Let's summarize. So these are the different. So that was the -1%. This one's 2.89. That was 1.31. It's 2.30. 0.93, 2.32, and those were our strategies. So the strategy here that the strategy, execution, time required, and currency pairs, right? I've just filled in some metrics here. So the strategy is what we call power trends. That's the name of this strategy. It's one strategy, right? Currently there's 8 strategies. There's 4 institutional grade day trading strategies, which we have. There's 2 beginner day trading strategies and 2 beginner swing trading strategies, which is what we've got here, right? So this is one of 2. It's pretty simple, pretty straightforward swing trading strategies called power trends. Now execution is what we call non-discretionary. So that means when an entry presents, you place the trade. We're not looking for other elements. It's very what we call mechanical. So mechanical or non-discretionary means the same thing. It means if this, then that. There's no fanciness. There's no extra added sauces and seasonings, such as I want to see a minimum of 5 rejections off a support level. You know, you can incorporate these elements just to increase the strike rate, and you usually want to be more stringent on your rules, right? We're not going to just remove any of those 6 criteria, but you can add more things, and then you can go and backtest and see, oh, if I entered with XYZ criteria over the course of a year, would my result at the end of the year been better? We didn't even incorporate any of that, right? And there are some best practices, but for this is just the raw, non-discretionary, mechanical strategy, right? Just following the checklist. Now, time required, less than 1 hour per month. Now, why I say that is this is for this one currency pair, right? Now, there's 28 currency pairs out there, and to go through all of them will take you no more than 1 hour per day. And the markets are only open during business hours, during business days. So 5 days a week. So how much is that? 20 to 22 days per month, which that works out, about an hour a day total. So for this one currency pair, is less than 1 hour, if that makes sense, right? Because this is just one currency pair. You're going to get more than that. You're going to trade more than just one currency pair per month. You could be looking at all 28. We could be looking at other alternative asset classes, right? So for this specific result that we achieved, this is almost like 1/20th of an hour per month, if that makes sense. Oh, no, it's about probably 1 hour or thereabouts, right? Looking at this one currency pair. So the time frame was about over the course of more or less 6 months, right? So that's the result that we achieved. Trades placed, 5. Again, we had to go back to find that extra one. If you want to incorporate that into the data, you absolutely can. The strike rate, I didn't want to write 100% because it's not a 100% strike rate, but for this strategy, it's around about a 75% strike rate, right? Just from looking at historical data. The average reward risk, so what is the average return per trade that we placed? And it was 1.95%. So that was combining the five different, the five profits, dividing that out by 5 trades. Is 1.95 reward risk. So it's a positive reward risk ratio, right? The strike rate is beyond 50%, and the reward risk is beyond is in the positive. That's what you want from a good, reliable strategy. And now the profit, if you start with 10K, is $975, right? Which is 9.75% return over the course of 6 months of only one currency pair, right? And it is, as I said, less than 1 hour per month looking at this. So, swing trading is incredibly lucrative, especially if you're working full time or if you're traveling the world or you've got a business on the side that you're actually focusing on the business and you just want to use trading to supplement your income. Swing trading is a fantastic place to begin. Now, if we were to incorporate the data over the past 6 months for all 28 currency pairs and incorporated another strategy, the reversal strategy on top of that, you can just imagine what that return would be like, right? So, a return per year, anywhere between the goal for the beginner trader, the novice trader, is to get to 5% monthly return and as soon as possible. That might take 6 months, it might take 24 months, it might take you 3 years if you're doing it very part-time. But if you take it seriously, I know traders that have been able to quit their job in under 6 months, and four months I think is the record I've ever heard. But 4 months, 7 months is a pretty common, but 12 months, 24 months, whatever it is, it's when you're a full-time trader though, your life can completely mold around you. You can change your life with this stuff, with this pretty straightforward strategy, with this one strategy, right? So the goal of 5% per month is milestone 1 as a trader. Now 5% per month compounds each month, and it compounds to 79% return per year. Now let's have a look how that looks on a scaling planner, which we've got, which is another tool that I've created here. If you started with a 10K account, we've ignored income, savings, and so on. This is built for investing and investing more capital into your trading account. So if you're still working a full-time job and you've only got 10K to start with, you can supplement that with some of your income, of course, right? That'll scale your account much faster. But let's just say you start with $10,000. If you're making a 5% monthly return and you've got some still even paying tax on your trading, over the course of 5 years from now, your account will be $92,000 and your monthly return will be $4,600. So you'll be able to quite comfortably, well, for many people, replace their income, right? Now, if you have a bit more capital or you manage to scale up your account as you're growing, as you're growing the capital, you're scaling it, but you're also adding, you're supplementing to that. 50,000 would look like 5 years from now, you're at almost $500,000 and you're making $23,000 a month, right? Now, what does 100,000 look like? In 5 years from now, you're at nearing $1 million and you're making $46,000 per month, right? Now, 100,000, I know that many of you are probably thinking, how the heck am I ever going to get to $100,000, right? Maybe some of you, we've got traders that are coming in here already beginning with 6-figure accounts and starting from there, but it's not that common, all right? At least the people that I speak to, the ones who want to get into trading, are to quit their miserable fucking job, right? They don't like the boss, they don't like what they do, and they would rather do something alternative. So what I say with that is what we're going to cover in not next lesson, but the final lesson is turning $2,000. Let's say you've only got $2,000 in your bank account, how you can turn $2,000 into a $4,000 monthly income in pretty much tomorrow, as long as you learn the skill set, right? In this case, this is a $100,000 account. As I've said in the past, as I might have mentioned in one of the previous videos, the money is in the skill, right? The actual account size, there are prop firms out there, there are companies willing to give you money when you become an experienced trader. And I've just landed another $100,000 trading account from another prop firm, on top of my already multiple hundreds of thousands of dollars of trading capital, where I get an 85% profit of the revenue that I generate from that. So you can imagine, even on a 100K account, you're doing 5% per month. That's $5,000, and then you're getting 85% of that, you're getting $4,000. You can pass one of these prop firm challenges in under 2 months, right? Provided you know the skills, you get the knowledge, you follow the pro trader method. Yeah, so again, whether you got 50 bucks or you got only a couple of grand in your bank account, that's okay. There is methods to that. You just need to learn the skills to be able to trade effectively, which is exactly what Pro Trader is here to help you achieve. Guys, I'm going to wrap this one up. I know it was a chunky lesson. I'll see you in the next one, where you're going to go through, we're going to set up your systems, set up your a demo account for your, so you can start placing trades, paper trades, set up your trading software, and then we're actually going to walk you through the steps how to place your first trade in the market. Very exciting stuff. Take care. I'll speak to you then. Bye for now.